Good start for the Bank Nifty, good start for the FMCG index, good start for the IT index, and a good start for beaten down metal names as well. So globally, concerns of a monetary tightening are fading away, especially after reassuring comments from Bank of England and ECB. Kenneth, do you think globally the worst of the news flow is now behind us? Markets were scared after the Fed communication, but now other central bankers are clearly indicating that in the near term they are likely to follow a loose monetary policy.
I think we will continue to see news flow from that part of the world, and that's been happening for the last, ever since the financial crisis of 2008 and 9. So to really try and predict what's going to happen in that part of the world is beyond us, because they run their economies based on the situation that's there on the ground. I think for us, whatever we've seen as far as the domestic environment is concerned, and the fall of the rupee, the high fiscal deficit and the high current account deficit is more of an effect of what this economy has gone through over the last couple of years. So our sense is that we've got to repair all of this bit by bit, and only then is when you will see an actual recovery coming on the ground. So we're not in the same camp that the rupee is a cause of what's happening to inflation, but it's more like the end effect of what's happened, because 4 or 5 years, there's not too much that's happened on the ground to actually boost up sentiment as far as the economy is really concerned. So I think we've got to manage it ourselves, and we've got to come through this situation after a reasonable amount of pain in the economy.
So Kenneth, when it comes to stocks and sectors, what is it that you're liking right now?
I think there are two parts of it. One is historically India has always been a growth market, and we've always looked at companies that will grow within the environment or grow through consolidation of an environment. The second, which usually comes for a little while, is markets which tend to get cheap, and that's also the cause that's also because there's not too much happening in the environment itself. So I think you're tending towards being more of a valuation-driven market at this point in time, because growth is reasonably absent in the economy. So that's how portfolios have been shifting moderately, though it's not been a very successful. It hasn't been very successful in terms of demonstrating short-term movements of the portfolio. So in a way, cyclicals have taken the brunt of the economy, and while they look cheap, they appear to be getting cheaper by the day. On the other hand, companies which have got stable balance sheets and are reasonably to well priced in the system continue to be the favorites around which the investors are moving towards. Okay, so from our standpoint, we've basically straddled both ends. We've kept our historical bias towards the consumer part of the economy. So we've been buying cyclicals over a period of time, which includes the public sector banks, some part of utilities. It's not been very remunerative from a portfolio standpoint.
But I can see 4 PSUs in your portfolio: Punjab National Bank, State Bank of India, GAIL, GSPL. Do you like PSUs now?
It's also a valuation play, and when it comes to the utilities, most of these guys are not financially stressed. Now you can question their growth going forward, but that's what we tend to like. We like businesses which are not financially stressed. When it comes to the public sector banks, I think there is reasonable amount of stress still left to come on these banks, and over a period of time, we only question whether these banks will continue to remain solvent, and they are an extension of the economy and the extension of the government itself. So we're taking the call that they will remain solvent for the next 5, maybe next 10 years, and they're available at a price point that we haven't seen from a very long time. While saying that, there is reasonable amount of concern on what they have lent to historically and how long that pain will last.
But if I look at a declared portfolio, you don't own pharma stocks, you don't have a large exposure to IT, be it large cap IT or mid cap IT, at a time when just about everyone on the street is of the view that it is time to buy exporters because of weakness in rupee, you're not investing in exporters in a big way.
Okay, I think we come from a background that you can't expect a weak rupee to be, you can't build a business plan around a weak rupee. I mean, it starts and ends with that. While the 90s you saw technology actually make it through and outsourcing become a very significant part of the entire economy. Over a longer term frame, I don't think you could build a similar kind of model around pharmaceuticals and IT all over again. So weak rupee, I mean, it helps in one aspect. I mean, rather than look at it from an exporter point of view, India's traditionally been a domestically driven environment. So maybe the next round of capex could be more import substitution and more domestic capacities to meet domestic demand, rather than put all your money around an export-oriented environment. Because while the rupee is weak, you've got a number of other currencies which are following a similar pattern. So we really don't know. We can't comprehend as to how you could build a business model around something which is not sustainable, neither is predictable.
Kenneth, what do you think with the weakening rupee and as well as what's happening to commodities, what's the RBI likely to do come its next policy? And if again we see a status quo, would the markets be acutely disappointed?
I think we're sitting with a situation where there's not going to be much change as far as what the RBI will do in the near term. Okay, and if it's going to be status quo, obviously the market's not going to like it, but the market hasn't liked a lot of things in the past. But these are near-term measures that we're trying to execute to find a quick fix solution with the environment. And I don't think that if you ease the liquidity situation or drop interest rates, I don't think that's the magic wand of turning around this economy. It's not going to be fiscal stimulation. There's a lot more got to do with the environment to bring back India to where it used to be about 5 to 6 years back.
So how exactly are you playing the consumption story? Because in the past when we've interacted with you on this forum, you've made a case to buy into mid-cap consumer names, companies which have a niche presence, companies which have a big brand. Are you still focusing on that end of the market where you are giving expensive large-cap FMCG stocks a skip, but you are positioned strongly in the mid-cap consumer names?
Okay, when it comes to the consumer part of the economy, let's put it this way. If you are allocating capital to equities in India and actually playing the growth part of the entire market, I think in the longer term, that's the only part of corporate India and the consumers where the balance sheets are not broken. They are deleveraged, okay, and they are adding to capacity. On the other hand, if you look at the investment economy, okay, if you look at the capex round that you've had for the last 10 years, whether it's the financial system or whether it is private sector banks or whether it's the government of India, I think each component of that environment, the balance sheets are broken. The profitability is nowhere close to what you had in 2005 to 2008, and that will remain a drag to question future investment in the economy. So what we're looking forward to as far as the portfolio shift is concerned is we're just looking at some kind of stability in that part of the world, okay, in the part of the world where a lot of capital is gone in. And if that market stabilizes, I think consumers will come back as one of the largest growth engines for the capital market. Okay, so our midterm outlook to consumers is still reasonably large and positive. In the near term, we just need this economy to find some kind of stability, some kind of resolutions to balance sheets actually getting better, and I think then we head into territory where we would see consumer demand being much ahead of what most expectations are. So that's the part of the market that we like. So we're pretty capital market agnostic, or capitalization agnostic, and we tend to have a longer term bias towards the consumer business.
Do you think money will still be made in a liquor company which you own?
I mean, it's a segment which is seeing fair amount of traction, and if you deleverage that balance sheet, if you eliminate some part of the portfolio which is not making money, when I say portfolio, I'm talking about company portfolios which is not making money, it will be interesting to see how these how the numbers actually trend up. And it's an industry which is struggling for profitability. It's not a company or two which is struggling for profitability, because we own a lot of names in that segment. And if you can exercise pricing power, if you can get yourself around to tier up in terms of the price points, there is fair amount of money to be made. Yes.
Kenneth, good chatting with you. Really appreciate you taking the time out and joining us this morning.